In today's episode, we're diving into a very hot topic involving banking elites, personal relationships with disgraced financiers, and the ongoing failures of regulation that are, once again, bringing to light the darker side of finance. That's right, folks, we're talking about how a cache of documents from JPMorgan Chase set off a chain of events that's led to the permanent banning of Jes Staley, former CEO of Barclays, from the UK financial services industry. It's easy to get wrapped up in the juicy scandal of it all. I mean, how could we not? We've got a high-ranking banking executive, a convicted pedophile financier, and a regulatory investigation that's cracking open the inner workings of a world few of us ever get a peek into. But let me tell you, this isn't just a story about one man's fall from grace. This is a powerful reflection of the deep systemic failures in the financial industry, from the lack of transparency between big banks and regulators to the ethical blindness that seems to be a prerequisite for climbing the corporate ladder. Let's lay this out clearly. Jes Staley, a man who climbed to the top of not only Barclays but also spent decades rising through the ranks at JPMorgan, has been found to have maintained close ties with Jeffrey Epstein, the notorious sex offender and financier, even after it was crystal clear who Epstein was. After Epstein's initial conviction for sex with a minor in 2008, Staley still stayed in close contact with him. There are reports of friendship emails, visits to Epstein's luxury properties, and even Staley allegedly seeking Epstein's advice on matters like pay negotiations with JPMorgan CEO Jamie Dimon. Now, we aren't talking about one lapse in judgment here. What we are seeing, and what has been revealed in this flood of internal documents handed over to the Financial Conduct Authority, FCA, is a pattern of extremely high-level executives like Staley knowingly overlooking Epstein's predatory behavior because, well, Epstein was a useful guy to have around if you wanted to strike up business deals with the ultra-wealthy. What baffling arrogance, right? The real kicker is how an individual responsible for leading one of the world's most important financial institutions, someone with an entire department of risk management and corporate governance at his disposal, could dismiss undeniable evidence of heinous criminal activity because it wasn't convenient. But herein lies one of the most important points: institutional moral failures are no accident. In big financial institutions, decision-making power is often centralized among a handful of top executives, and without proper checks and balances, corruption, whether moral, ethical, or financial, quickly spreads. Now, one might wonder, where were the regulators? Wasn't it someone's job to monitor compliance and ethics? This brings us to the larger systemic issues of how finance, power, and regulation interact in increasingly disturbing ways. While the Jes Staley scandal encompasses personal moral failings, it undeniably points to a larger issue about how these massive financial institutions operate. Think about the role JPMorgan played in all this. Epstein remained a client of JPMorgan's private banking services for more than a decade after his initial conviction in 2008. You even had a few compliance officers ringing alarm bells to no avail. So, what we're dealing with here isn't just one rogue banker, it's a reflection of an entire institution finding ways to skirt accountability. Shouldn't JPMorgan, with all of its layers of oversight departments, have been on top of it? It's not like Epstein was some anonymous small-time client. He was handling millions, if not billions, of dollars. So where was the meaningful regulatory scrutiny from the top? And it only gets worse. After Staley leaves JPMorgan in 2013, months later, the bank finally decides to drop Epstein as a client. Coincidence? It's clear that Staley very likely shielded Epstein during his tenure at JPMorgan. But more importantly, the bank had the data. The compliance officers had warned about Epstein's dealings. Yet, they chose to retain him as a customer because, well, the profits were too good to ignore. In a way, JPMorgan outsourced its moral responsibility to executives like Staley. But here's the rub: this financial outsourcing of morality is embedded across the entire industry. Even more alarmingly, a recent study found that over 40% of top financial institutions globally still don't have proper monitoring mechanisms in place to evaluate clients tagged for criminal or ethical breaches. We are talking about systemic negligence. How typical is this? Only after these damning email exchanges and document caches surfaced does the FCA come running in and finally take action. The UK Financial Conduct Authority dedicates itself to ensuring ethical behaviour in financial services, but this scandal exposes how it often acts only after the fact. For years, Epstein's criminal activities weren't exactly a secret. They were plastered across newspapers globally as early as 2005 when the Palm Beach police started investigating him for sexual misconduct. Then came his conviction in 2008. Yet, here we are, more than a decade later, uncovering that powerful financial figures were still dining with him, visiting his luxury properties, and swapping business deals. Domestic and international regulators largely turned a blind eye. Let's be clear, it took internal documents leaked by JPMorgan, unearthed during lawsuits, to trigger any real regulatory action. Staley's career ended, not because regulatory bodies were diligently monitoring his behavior, but because lawsuits finally peeled back the curtain on this cozy relationship. Where was the FCA, or for that matter, JPMorgan's own internal watchdogs, while this was happening? It seems like regulators, across the board, react rather than enforce. Global financial institutions continue to hold so much unchecked power that the threat of financial regulation feels more like suggestions rather than mandatory oversight. And so a real systemic issue emerges, the perpetual delay in regulatory enforcement, not just by the FCA, but globally. It's happening across the US, Europe, and countless other financial hubs. By the time regulators jump into action, the public damage is usually already done, and the executives have walked away with golden parachutes rather than criminal charges. These scandals don't just create drama for headlines, they have serious financial repercussions. The fallout from Staley's ties to Epstein has been catastrophic for Barclays, prompting clients, investors, and businesses to scrutinize their relationships. Stock prices take hits, trust erodes in financial institutions, and those left holding the bag are often innocent employees and stakeholders who had nothing to do with the actual wrongdoing. Let's talk numbers. Barclays stock tumbled by more than 4% following Staley's departure. Clients pulled approximately $4 billion in assets from Barclays' premier banking services division in the months following the disclosure of Staley's Epstein ties. For an institution that prided itself on wealth management and reputation, this kind of reputational damage is devastating. More recently, similar scandals from banks around the world, often with equally top executives being ousted for ethical breaches, have shown that ethical misconduct can wipe out anywhere from 15–20% of a bank's stock market value within months. Even JPMorgan, amidst all the lawsuits and settlements tied to their connections with Epstein, took a significant hit. The $290 million settlement with Epstein's victims was just the beginning. Analysts estimate that the actual reputational cost to the bank could be upwards of $1 billion in lost business and legal fees over the coming months. The U.S. Virgin Islands also extracted another $75 million, shedding further light on the astounding sums tied to accountability failures when it comes to top clients. Furthermore, financial institutions typically rely on their reputation for robust client relationships, especially ones dealing with the most elite, like private banks catering to ultra-high net worth individuals. Trust is everything in this sector, and once that's gone, it can take years, if not decades, to rebuild. So, what now? Can behemoths like Barclays, JPMorgan, or, for that matter, global financial institutions in general, really learn from these scandals? We'd love to say yes, but recent history gives us every reason to be cynical. There's a chance that accountability may finally stick, but that takes courage and political will, two things which, unfortunately, financial elites have often engineered to avoid through extensive lobbying, political donations, and building cozy relationships with regulators. Financial regulation is deeply politicized, and as we've seen repeatedly, change only happens at a glacial pace. However, new models of decentralized finance may present an intriguing alternative. As blockchain-based ecosystems grow, they bring the promise of greater transparency, lower corruption potential, and, most importantly, decentralized audits. The DeFi model directly counters centralized power in banks like Barclays, JPMorgan, and others, which thrive on informal, unchecked relationships between senior executives. But before we get too excited, remember that even the rise of DeFi hasn't been without its issues, and regulators have started cracking down there too, albeit with their usual lack of speed. So, for everyday investors and professionals watching all this unfold, what should you take away from the latest Staley-Epstein debacle? First, even major financial institutions, with all their regulatory frameworks and corporate governance policies, can't save themselves from scandals when their leadership is morally bankrupt. If you're investing in banks or any financial service companies, it's critical to pay attention to reputational risks and governance policies. Look beyond the balance sheets and earnings reports to understand how these institutions operate at their core. Second, the lax enforcement of regulations means that scandals like this one won't be the last. That means it's vital to build your financial decisions on a diversified portfolio that isn't overly tied to any single institution or sector, because scandals in finance can lead to sudden, unpredictable stock plunges and financial instability. Companies that seem rock solid one day could be rocked by a scandal the next, with billions wiped off their market value almost overnight. We've seen it with Barclays, and it's happening more frequently across the financial industry. Lastly, never underestimate the power of public sentiment and media coverage. In a world where information spreads faster than regulators can act, a company's real-time reputation, and its clients' perception of that reputation, matters more than ever. Cases like Staley's show that once the tide of public opinion turns, it becomes very difficult for companies to recover. What stands out most from this scandal isn't just the misdeeds of one executive or the very questionable judgment of one financial institution, it's the larger narrative that we keep seeing play out time and time again across the world of global finance. The industry appears to continue rewarding those at the top despite moral failings, all under the guise of maximizing profits. This is not an isolated incident, it's part of a troubling trend of ethical failures at the helm of global financial institutions. We saw the same kind of moral failures with Wells Fargo's fake account scandal, where thousands of employees were pressured to set up accounts without customer consent. Or look at the 2008 financial crisis, where reckless risk-taking and the mishandling of mortgage-backed securities by banks like Lehman Brothers and AIG resulted in millions of people losing their homes. The pattern is consistent: profits are prioritized over ethics and regulations are intentionally loose or ignored altogether until it's too late. But these aren't just past events. Even today, we are seeing the fallout from the lack of adequate oversight in the world of high finance. Take Credit Suisse, the Swiss banking giant, now facing major scrutiny after its collapse in 2023, partially due to risky lending practices, including questionable relationships with sanctioned clients. Regulatory complacency and the willingness of institutions to turn a blind eye to unethical behavior remain pervasive across the industry. These failures are symptomatic of a larger structural problem within the financial system that prioritizes short-term profits over long-term stability and ethical governance. One of the most damaging aspects of scandals like the Staley-Epstein saga is how they erode trust in financial institutions. Trust is the invisible currency of finance, and when institutions like Barclays and JPMorgan are implicated in moral failings, it drives a deeper wedge between Wall Street and Main Street. This fall in public trust can have long-lasting impacts. Consumers may begin to question whether the finance industry, as it stands, actually serves the public good or merely enables a system where the wealthiest and most powerful can game the system. The trust crisis isn't just theoretical. A 2022 Gallup poll showed that trust in banks has remained at historic lows since the aftermath of the 2008 financial crisis, with only about 34% of Americans expressing any confidence in the industry. Such skepticism is justified, especially when these financial scandals continue to unfold around the world, leading to growing calls for more fundamental reforms in the way the financial system operates. These include proposals for enhanced regulatory frameworks, increased transparency, and shifting corporate governance models towards stakeholder capitalism, where companies account not just for profits, but for the well-being of their employees, clients, communities, and the broader economy. The role of regulation in this scandal, and frankly in most financial misconduct cases, invites serious skepticism. Regulators like the FCA acted only after significant pressure, and it took a lawsuit for many of these damning documents to even come to light. It begs the question, where were they when all of these questionable ties between Epstein and major financial figures were common knowledge in insider circles? How has the system allowed people like Staley to reach the very top without accountability? It's clear there is a fundamental delay in the enforcement of existing regulations. Historically, regulators have been underfunded, outmatched, or too politically entangled with the institutions they are tasked with policing. The lobbying power of financial institutions has successfully softened regulatory oversight in key areas, allowing powerful executives to make decisions that benefit short-term profit but harm long-term stability and ethical governance. Consider this: as recently as 2019, Epstein's ties to major financial institutions were still being dismissed or downplayed. The global financial industry's unwillingness to enforce its own ethical standards speaks volumes. It's as if these titans believe they operate in an alternate universe where accountability only catches up with them in rare, headline-grabbing moments like the fall of a CEO or a huge legal settlement. Indeed, the sluggishness of regulatory bodies like the FCA is a glaring symptom of broader industry failings. Regulation often only kicks in after the fact, when damage has already been done. If the FCA and other global regulators had proper mechanisms in place, wouldn't they have acted as soon as Epstein re-entered the public spotlight amid accusations of sex trafficking in the mid-2010s? Wouldn't JPMorgan have been more forthcoming with the damning evidence much earlier, instead of just moving to cover its own rear after Epstein's 2019 arrest? Moving forward, real change in the global financial industry can only come from systemic reform. Here are a few directions that could lead to a more ethical and stable financial sector. 1. Stronger regulatory frameworks with proactive powers. Regulators must be given proactive powers to investigate potential conflicts of interest, financial misconduct, and unethical behavior before they metastasize into full-blown scandals. These regulatory bodies should have the authority to compel financial institutions to disclose client relationships when those clients are involved in criminal investigations, not merely sit on their hands until a court rules they have to release documents. 2. Mandatory ethical audits and external compliance reviews. Currently, much of the financial world operates under self-policing practices when it comes to compliance and ethics, often with internal auditing departments reporting to the very executives whose behavior they're supposed to monitor. This poses a clear conflict of interest. Financial institutions need mandatory third-party ethics audits and external compliance reviews conducted by independent bodies to ensure that executives and institutions are adhering to ethical standards and legal requirements. 3. Transparency mandates for high-profile clients. High-net-worth clients like Epstein should automatically trigger enhanced monitoring by both internal compliance and external regulators. Financial institutions should be required to report certain client relationships as soon as criminal convictions or accusations are raised, especially when those clients are publicly known for criminal behavior, as in Epstein's case. 4. Holding leadership accountable for ethical failures. Financial institutions have long shielded their upper management from direct consequences. There needs to be a shift in corporate governance, where boards are held accountable for ethical failings at the executive level. Corporate bonus structures should include clear ethical guidelines, with financial penalties or clawbacks tied to any ethical breaches found. 5. Reform of banking culture and the moral compass. Changing processes alone won't solve the issue if the underlying culture in finance does not also evolve. There needs to be a seismic shift in banking culture itself, one that moves away from the profit at any cost mindset and prioritizes a broader sense of corporate responsibility. Instituting meaningful change won't be easy. The financial sector, by nature, is resistant to regulation and oversight, much less changes that would hit executives in their wallets. But the reputational and financial costs of continuing in the same direction are mounting. If banks and financial institutions fail to take significant steps now, then the entire sector risks becoming regarded with the same kind of distrust that other discredited industries, like big tobacco or fossil fuels, have faced. Public trust, once broken, is nearly impossible to rebuild, and scandals like Staley's only add more fuel to the fire. In a world where massive financial institutions wield outsized influence over not just economies but entire political systems, it's essential that ethical, responsible management of that influence becomes the norm, not the exception. As the dirty laundry from the Staley-Epstein ties continues to unravel, this scandal should be a wake-up call for both the financial industry and regulators to start doing better. Because if they don't, well, then buckle up. More colossal fines, more executive resignations, and more regulatory failures, it's all coming. Until the financial world gets its ethics in order, these kinds of scandals will continue to be the unfortunate, but inevitable, outcome of an industry that has yet to learn its lessons. And you, the investor, ordinary citizen, or finance professional, will have to continue navigating these turbulent waters, wondering when the next scandal will hit. So keep your portfolios diverse and your skepticism high. Financial giants may think they're untouchable, but as we've seen, even the biggest players fall hard when truth, or just a mountain of damning documents, comes to light. That's our analysis for today, folks. I hope this deep dive into the Jes Staley and Epstein scandal helps shine a light on the systemic failures that lurk behind the headlines. Stay informed, stay skeptical, and most importantly, demand better from the institutions that control so much of our global economy. We'll see you next time for more of the real talk behind the financial markets.